In this video, we're going to review the effect on your taxes by pulling money out of different tax buckets. Now, some of these buckets are forced upon you, right? If you have a taxable account, you might have dividends and interest that are hard to avoid. But then you get to make some choices. You get to decide if you're going to take capital gains or an IRA distribution, or are you going to do a Roth conversion? And what effect does your pension have on your overall taxes? So all of these different buckets stack on top of one another, and we're going to start out with the basics and then build from there. Now, this couple has a $2 million taxable portfolio. So that taxable portfolio, non-IRA, non-qualified accounts, are going to be generating taxable income for them. So let's take a look at how that affects their overall tax brackets. So the first thing that we're going to look at is what's called dividends. Now, dividends comes in two different shapes. So one is ordinary dividends, which is going to go against their ordinary income tax brackets. And the other is what's called qualified dividends. So this couple has about $40,000 worth of total dividends, of which $12,000 is going to be qualified dividends. Now, those qualified dividends are going to go into that long-term capital gains and qualified dividends bucket, which we'll get to in a moment. But on top of that, they also have $6,000 worth of interest or taxable interest. So when you think about taxable interest, and this is going to go against your ordinary income, think about bank interest, certificate of deposit, taxable bonds. So think about treasuries and corporate bonds, but then also money market accounts are going to generate taxable interest for you. So that's all going to go into your ordinary income tax bucket. So here we can see the total dividends for this couple is $40,000. And then we're going to add that $6,000 worth of taxable interest to their total income of $46,000. Now, here's where it gets tricky to calculate because the total standard deduction is going to be taken against that. But there's an order of operations in what that standard deduction offsets. So in this case, their standard deduction is $30,000 a year. Now, remember, if your itemized deductions don't surpass your standard deduction, so medical expenses, charitable giving, state and local tax, if all of these things don't surpass your standard deduction, then you just take your standard deduction. So that standard deduction is going to be taken off of that total income, but what's going to be left out of this $16,000 is really going to be a portion of their ordinary income and all of their qualified dividends. And their total tax is going to be $400. So now you might be asking yourself, why did they only pay $400 in taxes? Well, out of that $16,000 of taxable income, a portion of that was qualified dividends, right? So $12,000 of that is going to be qualified dividends. So what happens is that out of that $16,000, only $4,000 of it is taxed at the 10% tax rate. And where did the $12,000 go? It went to these long-term capital gains and qualified dividend bracket. So in this bracket, you can make up to $96,000, $97,000 and pay 0% taxes. So that $12,000 had a 0% tax break. Now here's the trick, because ordinary income goes against your long-term capital gains and qualified dividend brackets, but long-term capital gains and qualified dividends don't go against your ordinary income brackets. So here you can see the total amount is going toward this bracket. The total amount of taxable income is going to fill up this bracket, but only the qualified income, that $12,000 worth of qualified dividend income, is going to be taxed at the 0% tax rate. Now, I know everybody can't live off of $40,000 a year, and that's okay. I wanted to start with some lower numbers so that we can see how everything builds on each other. But let's say we need some more money. Let's say we need an additional $50,000 a year to live. So this couple had $2 million in a taxable account. Now, the way taxes work in a taxable account when you sell something is that you're going to realize a gain. So if you buy something for $10,000, and you sell it for $20,000, well, you don't pay taxes on the whole $20,000. You only pay taxes on the gain. So from $10,000 to $20,000. So in that example, you realize $20,000 worth of liquidity for spending purposes in retirement, but you only pay taxes on that $10,000 gain. Now, in reality, you can mix and match where you take that money from in your portfolio. And sometimes you can even take some losses to offset your gains and lower your overall realized net gain in that portfolio. And that's often a strategy that we employ when we're raising cash for clients in order to minimize their tax liability. Let's assume for a second that every dollar this couple raises in retirement from their investment portfolio, from their taxable investment portfolio, is 50% basis, right? What they paid for it, and 50% gain. So let's assume that they raise $50,000. So $25,000 of that is going to be a gain. And this is where it's going to go. So we got long-term capital gains. Now, if they were to sell it for short-term, so if they were to hold it for less than a year, it would be a short-term gain and it would go straight to their ordinary income tax brackets. So it would jump right into filling up this bracket. And so most of the time, if you can avoid it, you want to take a long-term gain because that's going to go to your long-term gains bucket. Now, while their total income here is $71,000, I know and you know that they actually have $96,000 worth of liquidity, right? Because they only realized a $25,000 gain, but they sold $50,000 worth of stocks and bonds. So far they have $96,000 worth of liquidity to spend. And here's where it gets cool. So even though they have $96,000, $71,000 of that is overall taxable, when we look at their ordinary income tax brackets, they still only have $4,000 worth of ordinary income and their taxes are still $400. So going back to the last example, we were only paying $400 worth of taxes, an average rate of 0.6%. And then we raised $50,000 in cash for spending purposes, and we still stay in the same bracket. The reason why is that if we look at their overall long-term capital gains and qualified dividend bracket, all of that gain went to fill that bracket. So now we're at $41,000 of total income. That's the $71,000 of total income minus the $30,000 deduction. And then $37,000 of that is considered qualified income. So qualified dividends plus long-term capital gains, all of which falls within the 0% tax bracket. So now what about a pension? Where does a pension fall within the mix? Well, building on our previous examples, we now have $46,000 worth of dividends and interest. We also have $25,000 worth of capital gains, but some of that was basis, right? So we raised $50,000, $25,000 of which is a taxable gain, and we get $96,000 worth of total spendable money. Now, if we add a pension to the mix, it's going to go straight into that total income. So it's going to go to fill that ordinary income tax bucket. And here we're out of the 10% bracket. So we've filled up that whole bracket and now we're bumping into the 12% bracket. So 12,000 of our total income in that year out of the 36,000 worth of total income, right? Ordinary income, everything that's going to be included in this bracket is being paid at the 12% bracket. And then we have still $37,000 that's being paid at the 0% tax bracket. Now, because we added a $32,000 pension, and now there's $32,000 worth of additional income, that money is still going to be included against the total long-term capital gains and qualified dividend bracket. So if we look at that total income is still going toward filling up this bucket. Now, once we get out of this bucket, once that bucket is filled with either long-term capital gains or ordinary dividends, all the qualified income above that amount is going to be taxed at the higher rate. So once our income fills up this bucket, the rest of our qualified income or long-term capital gains and dividends is going to be paid at the 15% bracket rate. But even with adding a $32,000 pension, our total tax is only up to $3,843 with a marginal bracket of 12% and an average rate of 37%. So if we go back and look at here in our marginal tax brackets for ordinary income, we still have quite a bit of room to run, right? So what are we going to do with this extra room to run? Because we don't want to just let it go. right? That some things that we do today are going to make our situation later down the road much better, right? Those little steps that we make that don't feel great today, it's like exercise, right? It doesn't feel great today, but it helps us a lot better down the road, right? Same thing with taxes. If we pay a little bit more tax today, whether through IRA withdrawals or Roth conversions, it can make for a much better tax situation down the road. So we want to take advantage of being in this 12% tax bracket and having so much room to run. So what can we do? We can take some IRA withdrawals, and we can also do some Roth conversions. Now, it's possible that we might need some of this money, right? We might need a little more money in order to just live. So we might not need all of it, but let's say we need $20,000 to live and we want to do $40,000 worth of Roth conversions, right? So around $60,000 worth of total income that we're going to generate through that strategy. So let's look at the overall effect. Here, our total income is going to jump to $163,000, right? So from 103 to 163. Our total tax is going to jump about $13,000. But because we did it strategically, we're still staying in the 12% marginal tax bracket, and our average rate goes up a little bit. So let's look at where we are in this ordinary income tax bracket. So we're bumping right up against this overall 12% tax bracket. There's about $73,000 of total room to run, and we're using up almost all of it. So out of $96,000 worth of ordinary income, $24,000 falls in the 10% bracket, and the rest of it falls within the 12% tax bracket, but we're not paying anything at the 22% tax bracket. So anything that we would have withdrawn or done a Roth conversion with over and above where we are today, then we would have had to pay tax at the 22% tax bracket. Now, there are some cases where people say, let's just go ahead and do it. And depending on your age, it might make sense. It could make a lot of sense in order to save on the taxes later on. But each and every situation is different, and you have to look at your personal situation and how it affects your overall financial plan and liquidity needs. Now, let's fast forward a couple years and assume that they're starting to take Social Security. But along with fast forwarding a couple years at age 65, you also run into what's called IRMAA surcharges, or those Medicare surcharges for making over a certain amount of money. So we're going to take a look at these brackets and see where that puts you if you make over a certain amount, and how much you actually have to pay in addition to your base level Medicare premiums. So if this couple were to have a total of $50,000 worth of Social Security income, their total taxable amount of their Social Security is going to be $42,500. Now, this is interesting because the total taxable amount of the Social Security isn't 100%. And depending on your income, it could be much lower, but 85% is the max that your Social Security could be taxed, or how much could be included in your taxable income. So that $42,500 is then included in the taxable income. And the reason why is because this couple makes over $44,000 worth of provisional income. So provisional income is a unique calculation that includes your adjusted gross income, your tax exempt interest, so municipal bonds, and half of your Social Security benefit. So if you ever wonder why your CPA always asks for what your total municipal bond interest was, it's because that is included in your provisional income calculation. So if your provisional income is more than $44,000, then 85% of your total Social Security benefit is going to be taxable. And those thresholds that I just showed you haven't changed since the 1980s. So when we add that $42,000 worth of total taxable Social Security income, it brings their total income up to $205,000. Now that Social Security income is going to go straight into those ordinary income tax brackets. So while we were in the 12% bracket before, now we're paying $41,000 at the 22% bracket. So that's going to bring our overall effective rate or average rate up to 12.6%. And every dollar we bring in over and above where we are today is going to be paid at that 22% bracket. So effectively bringing up our average rate for every additional dollar that we make. So now the other thing that we have to look at is those Medicare premium surcharges. Now this couple is bringing in over $200,000 a year, and that puts them right at the threshold. So it's pretty high. It's $212,000 for a married filing jointly couple, but they're only at $205,000. Now, if they were to go over $212,000, then they kick in those IRMAA surcharges, which comes out to about $2,000 total if they're both of Medicare age. And those brackets are like cliffs. They're not like the ordinary income brackets where if you spill over, you just pay an additional amount at that higher bracket. If you trigger IRMAA surcharges, you're going to pay the entire IRMAA surcharge. If you go to this bracket, you're going to pay $74 per spouse that's over the age of 65 times 12. And then you're also going to pay for your Part D of $1,370 times 2 times 12. So that whole thing comes out to about $2,000 for this first bracket, and it just goes up from there. If you're in this highest IRMAA surcharge bracket, you're going to be paying over $10,000 a year extra if both spouses are over the age of 65. So what could you do to offset this new source of income that you have? Now you have $42,000 worth of taxable Social Security income. What changes could you make? Remember, we were stacking everything on top of each other. We had $25,000 a year of gains. We had a Roth conversion at $40,000 a year. And we were also pulling out $20,000 out of our IRA just for spending. But remember, we were doing those Roth conversions and those IRA withdrawals because we were staying within the 12% tax bracket. So what if we back those out of our plan? What if now we say that we're taking Social Security income? Now, instead of taking $40,000 worth of Roth conversions, we only do $18,000 worth of Roth conversions. And instead of taking $20,000 out of our IRA, we don't take anything. So if we did that, our total income would be back down to $163,000. Total tax would be back down to $16,000. Our marginal bracket would be 12, and average rate would be back down to 10. So let's take a look at where we are in our ordinary income brackets. So we're still converting $18,000 into a Roth, right? We're still getting that $42,000 worth of Social Security income. But because we made those adjustments and we decided which bucket we were going to take money from, we were able to control our overall taxes and stay within that 12% tax bracket. It's also going to put us in a better situation when it comes to those IRMAA surcharges. So once we get to that age where IRMAA starts kicking in and Medicare premiums could go up, if we were to stop the Roth conversions or pare them back and also stop the IRA withdrawals as much, then we have a little bit more room to run in this first IRMAA bracket so that maybe we did need a $50,000 car or we needed some extra money and we wanted to pull it out. Well, then we have some more room to run and we're a little more resilient from a tax perspective and we have some more flexibility. Now, it's important to note that if we've been doing those Roth conversions along the way, now we have this other bucket that we could pull money from, and it's like in the eyes of the IRS that it never even happened. So in terms of these overall total income amounts and those ordinary income brackets, if we take money out of a Roth IRA, it doesn't affect those at all. It doesn't affect the ordinary income brackets. It doesn't affect the long-term capital gains and qualified dividend bracket. It doesn't affect any of them. And it doesn't affect your IRMAA brackets either. So that's why making those painful small tax payments early on can really pay off in the long run, because when you have that Roth account, you might not want to use it all up in 1 year, but you can use it strategically to take extra income when you need it without changing those overall ordinary income tax brackets. My name is Zach Morris. I'm the founder of Paces Ferry Wealth Advisors. And if you've enjoyed this video today, please go ahead and hit the like and subscribe button and be on the lookout for more videos in the future. Thanks for watching.